If you're wondering if you need to be conservative or aggressive with your investments leading up to or in retirement, my answer as a Forbes Next Gen Best in State financial advisor is you need to do both. Instead of withdrawing from your retirement investments at random or proportionately, I structure my client investments into two buckets. The first bucket is the war chest. We want to identify what the next 5 years of expected distributions look like and keep that amount of money in this bucket. These dollars should be invested in low volatility investments. We know you're going to spend these dollars over the next 5 years, so they should not be subjected to high levels of stock market risk. They should not be subject to market volatility and risk the way that stocks are. You can sleep at night because you know your next 5 years of income is protected regardless of what the stock market is doing. The second bucket is what we call the growth bucket. This bucket primarily consists of long-term growth-oriented investments, usually stocks. This bucket is required to help you outpace and grow your assets above and beyond inflation for years 10, 20, and beyond. You might be thinking to yourself, I'm in my 60s, why do I need a growth bucket at all? The reality is you need to protect your income for the beginning of your retirement, years 0 through 10, but you might be retired for 20, 30, maybe 40 years. It's crucial that you have an asset that is going to outpace inflation over time and protect against a huge risk for retirees, which is longevity. Having these two buckets gives you the confidence to spend now without sacrificing the long-term sustainability of your plan by having enough money invested for the future. Imagine if you retired in the fall of 2007, right before the big market crash. You would have intentionally withdrawn down that 5-year war chest bucket while your growth assets recovered for the next 5 years. At that time, you could sell those growth assets at a significantly better price than you would have been able to in 2008. If you were forced to sell them at that time, that can have an irreversible negative effect on your retirement. Implementing this strategy can allow you to have a sustainable retirement and spend with confidence, especially in the beginning of your retirement. You need to have a plan to manage market volatility in retirement, especially early in retirement. Learn how to have more stability and flexibility in retirement by hitting follow.